My pleasure to announce our keynote speaker, Jason Su. Jason is founder, chairman, and CIO of Rayliant Global Advisors. Rayliant applies quantitative methods to access behavioral-based alpha prevalent in inefficient markets. Prior to Rayliant, Jason co-founded Research Affiliates, a global asset manager with over $143 billion in assets managed utilizing its strategies as of June this year. Today, Jason will give us some keen insight on navigating these current financial markets, and we couldn't be more excited to have him. So without further ado, here's Jason.
Well, first of all, I want to thank everyone for attending. This is the first live conference, and certainly it's the first time I've seen so many people in the room for a long time. I just flew in from Japan yesterday, so if I'm a little incoherent, please, I apologize. And also, if someone could help me stay on track of time, throw something at me if I'm crossing my 30-minute mark. Now, first of all, I thought I was going to come in today and dress in a T-shirt and Bermuda shorts, and then talk about my personal philanthropy. I've been told that's a great way, much greater way to raise assets and to actually have content. But apparently that hasn't worked out so well recently. So I decided to go with the black turtleneck. I think Elizabeth Holmes and Steve Jobs are best known for that outfit. It's a little unfortunate that in our industry, oftentimes the content is less important versus how one dress up and the context that it brings. So what I'd like to talk about today, well, first of all, I think I owe everyone a little bit of an introduction. If I've interacted with you before, it's most likely under a different banner. So in the pre-COVID era, I worked for a firm, or I started a firm called Research Affiliates, and worked with Rob Arnott. So if I ever came by your office before, it was probably peddling the PowerShares RAFI or the Schwab Fundamental Index. So that would be how we might have had a relationship before. I spun out about 5 years ago to start my own company, Rayliant Global Advisors, where we do active ETFs. So it's a huge shift in kind of my personal career, and I think I'll start there. First of all, I mean, obviously, active ETF is a enormous innovation. We're seeing a lot of mutual fund managers who are now converting their active mutual funds into an active ETF, really representing the arrival of this chassis, it being more tax efficient, generally associated with greater transparency, associated with a more improved cost structure for the end client. So we ourselves have chosen to sort of exclusively use the active ETF as a chassis. But more importantly, because I was on the board of CFA, and sometimes occasionally I'm at fault for some of the curriculum that you might have to struggle through, we talk a lot about passive investing, why you should just buy the S&P 500, index to a low-cost ETF and be done with that. So why have I chosen an active ETF format, which is clearly active for one, and likely to be a bit more expensive for the second? And this is going to dovetail into the rest of my talk, which is when should one be active and when should one be passive? Of course, all of us here understands that alpha is, at the end of the day, a zero-sum game. So for you to be active, you got to think about, well, who's active on the wrong side, right? Who's losing his alpha to you in every given trade? We know in the US, that's a harder thesis to defend, right? I mean, it's a market that's by and large very institutional. If you're going to make alpha, where does it come from? Does it come from Renaissance technology? Does it come from Goldman Sachs prop desk? Probably unlikely. So the chance of you actually being the patsy in a trade is a little high. Now, of course, the U.S. has gone from being a 3% retail traded market to with Robinhood.com now 30% retail traded. So there may be a reason to believe in alpha in the U.S. after all. But when you start to expand that horizon and you think about emerging markets, right? If you think about emerging markets, Most of emerging markets are very inefficient, meaning their markets are quite young, so they're not as institutional. And when you focus deeper into the more Asian emerging economies, where retail gambling is in fact how they see their markets, right? They see their markets as casinos rather than for long-term retirement planning. There regularly, you look at South Korea and Taiwan, retail trading is about 60%, even though they've been somewhat developed as a market, been in the MSCI as a major constituent for the last 30 years. Right? And then obviously you throw in China, right, which is about 50% of your EM basket, they're at 85% retail trading. And so in those markets, the chance that when you make a trade, the person on the other side is completely ill-informed, suffers from behavioral biases, is actually quite high. And in those markets, I think as a more disciplined money manager, there is a case to be made that you want to be active, right? There is a reservoir of people supplying you with alpha. So let me start there with emerging markets. How many people here have emerging markets in their portfolio or in their client's portfolio? Yeah, most of us do, right? It's probably not a large slug, right? You got 5% if you're somewhat, benchmark, maybe 10 if you're a bit more adventurous. But be as it may, most of you have EM. Now, how many of you have been happy with having EM in your portfolio? Not a lot. There we got one person who probably made a very judicious choice in terms of getting the right manager in the mix. But most of us, surprisingly, not only has EM beta not been great because it's more volatile, and the result of which is it's sort of eroding the compounded return, but the active return for your EM manager has been lacking, which is a little surprising, and I'll get into that as well. So let me start with EM, the EM beta that you have in your portfolio. If you're interested, I'll sort of do a soft advertising. I just wrote a paper, which some of this talk is based on, that came out in the Journal of Portfolio Management, which gives you a very detailed decomposition into what drives EM return over time. Now, when we think about EM, right, we imagine, look, it grows faster. The underlying GDP is on average about 5.5% real, right? You contrast that with developed market GDP growth, which is, on a good day about 2.5%. And when you look at Europe, it's borderline, barely 1%. And then you look at Japan, there's zero growth. So you imagine, well, emerging markets, given those underlying economic growth conditions, that market has to do better over time from a return perspective. And it's also risky, right? You got higher growth, you got a little bit more risk, giving you more risk premium. It's got to be a better beta over time. But that hasn't been the case. And why is that? In fact, it's actually one of the biggest mystery in academic finance, which is why doesn't emerging market GDP growth translate into stock returns? And this sort of takes us back really to the primitives. When you think about what drives returns, right? All of us know returns aren't sort of this random number that the market gives you, or it's based on something. It generally, over time, is related to underlying EPS growth, right? A company, for it to have good stock price, sure, in the short run, the PE could go up and down, right? And that's a little random, hard to predict. But over, say, a 5-year horizon, a proper business cycle, what you expect is that price will track earnings per shares, right? If a company's actually producing profits, growing its profit, its share price over time will track that. So let's take a look at EPS growth for emerging markets. I just mentioned the GDP growth is about 5.5%. Guess what's been the EPS growth for emerging markets? Above 5? Raise your hand. Below 5? Raise your hand. You knew that was a trick question. So surprisingly, it's well below 5. And that's really weird, right? The real economy grows at 5.5% real, and the corporate earnings growth is barely 3%. And in fact, when you look at country by country, you'll discover two outliers. On the good side, you got China. So they've had, in the last 15 years, a real GDP growth of about 9% and a real corporate earnings growth of about 14%. So that's kind of the pattern you expect, right? And then you have sort of the negative outlier, kind of the basket case that's always in an emerging market, which is Argentina, where their corporate earnings growth is actually negative for a very long period of time, despite eking out kind of a 3% real GDP growth. But by and large, there's actually no relationship between a country's real GDP growth and its corporate sector earnings growth, at least in emerging markets. And that's super weird, right? It's like, wow, the listed companies seem to do something completely different than the rest of the economy. And when you look deeper, that's not actually as big of a surprise. What you discover is, again, outside of China, most of the emerging markets, their listed companies, are dominated by what? Want to take a guess? Government, state-owned enterprises. And that's because we live in the US and we have a very US-centric way of seeing the world. We're used to the fact that we got a vibrant venture capital market that helps provide funding to entrepreneurs, that help them take risk, dream aggressive, big dreams, build a company, and then list it. That condition, interestingly enough, exists primarily in the US and in China. It's not even broadly available for most of Europe, and certainly not available in rest of the EM. And the fact that it's available in China is actually mostly due to the US. We all know David Swensen of Yale, right, who is big about endowments and foundations being invested in venture capital because they have a whole longer horizon. And it was really his team, one of his pride Chinese graduate students who took that model with his funding to China and really built up the VC market there that funded the Alibabas, the Tencents, all of the phenomenal tech companies that you now see in China. And so we actually have two outliers. One is the US and the other one China. So as I mentioned, that's one critical ingredient you need to help your private company become big enough and list. The second condition you need is you need a listed market that's sufficiently liquid that really help you get an exit and help you unlock valuation. Right? If you have a market that has thinly traded volume, not a lot of international capital, no willingness from anyone to pay you a valuation multiple, you're pretty happy staying private and simply collect your own profit rather than being heavily regulated, dealing with bureaucracy, and list yourself. And again, by and large, for most of emerging markets, that is the case. Lack of venture capital to help you grow big. So you have a lot of successful mom and pop shops, a little small chain restaurant that could never get very large because of lack of capital. And then you also have bureaucratic red tape that makes listing just uninteresting, almost infeasible. So the result of which all you have are gigantic state-owned enterprises that run water and power who dominate your stock market. And that's not what drives growth, right? That's not what you want to participate in when you think about emerging market growth. And so the fact that you've been disappointed with emerging market is exactly for those two reasons. Just the lack of the basic ingredients to transform the real economy into the listed part of the economy that we as global investors can participate in. So now I'm going to pivot and talk about the outlier sample, which is China within emerging markets. Now, a few years ago, when I first started Rayliant Global Advisors, I thought, look, I was doing US large cap, which is a very efficient market, where eking out an alpha was very complicated and depressing on most days, right? I also happen to teach business school, and one thing I always tell my students is, you just paid $80,000 to come to my class where you think you're going to learn how to make money, and where I spend the entire course testing you on the impossibility of creating alpha, right? That is a very disappointing outcome. So I thought, okay, well, if I'm going to start my second startup, my second business, I've got to get out of that problem, right? And of course, I want to find the most inefficient market that I can get to. And it also has to be big enough, right? Like I can't go trade Vietnam because it's too small and I wouldn't get any client to give me money. So I had to find a big enough market that's inefficient enough for me to build a business around. And China, when I looked at my own emerging market research, I go, okay, well, here's an interesting enough beta, right? GDP growth, 9% in the last 15 years. It's now slowed down to about 6%, still 3 times of what you find in the average developed markets. Corporate earnings growth at about 14.5%, which is actually about 3 times what the developed market corporate EPS growth is. So this is a pretty good starting point from a beta perspective. And you got some alpha to boot, right? All I have to do is do better than someone who thinks stock market is for gambling, and I'll have some alpha. When I first got started, there was actually a lot of talk about carving China out of emerging markets. People thought, China is so big, right? It's like carving US out of developed market. That makes sense. Otherwise, your entire emerging market is just, whatever China's doing that day, your emerging market basket will do the same thing. And some people even thought, given how fast China grows versus the other emerging economies, it could make sense. Carve out China so you can have a dedicated overweight. How time has changed. Now most people talk about carving out China so that they don't have to invest in China and can just invest in emerging markets, ex-China and Russia. But be as it may, I will still spend my remaining 8 minutes talking a little bit about China. So what I hope to do today is to just share some tidbit from our research when it comes to how one might want to think about investing in China. Now, there's tremendous amount of negativity, so I'm going to start there, right? That's just the elephant in the room. For how many people here kind of paid attention to what just happened in China, the People's Party Congress? How many people saw that disturbing photo of the last president being escorted out of the room? So clearly, enormous negativity. We had that capitulation selling right after the Party Congress, where like over 2 days the market dropped something like 15%. Right? How should you think about that? Right? Is China simply too risky to invest in, given the politics? Is it simply too anti your ESG sensibility for you to want to get involved? Makes a lot of sense, especially if you got clients who are ESG oriented or they are kind of a state pension fund where optics is an issue. So setting that aside, let me talk about a few things. So first of all, a lot of what you and I understand about China comes from the Western press. So I spent last year 5 months in China, where I first did my 3-week quarantine in a randomly selected hotel. So that was an interesting exercise. That's when I discovered if I ever become a white-collar criminal and have to do minimum security prison, I'd be fine. But traveling 20 cities in China, I'll kind of share with you a few things that I think are sort of myth that we really have developed because we use an American lens to understand how things work in China. So I'll start with one analogy first. I think the way in which we all understand China is like someone trying to understand the Democratic platform by watching Fox News. Right? There's a certain color lens that we put on when we read things about China. So let's start with the easiest one. About every 2 years, Western economists and Western media predict that China is going to blow up because it will have a 2008-like global financial crisis driven by the collapse of its real estate. So why do we say that? Well, the one thing we did, get right is Chinese real estate is very expensive. Right? You take the price of a Chinese apartment and divide that into the average housing income, and it takes them something ridiculous like 30 years to ever pay off mortgage, right? So it's just very expensive. But there's a huge gap between something being expensive to prices crashing. So the reason why we think price of real estate in China will crash is generally because the way in which we American investors invest in real estate is it's an income-generating property, right? And the math is pretty simple. If my rental yield is 6.5%, and my mortgage cost is, 3.5%, so you're lucky you locked in, good rates 2 years ago, and I pay my property tax, I probably clip about 2% excess return, and that's a pretty darn good deal, right? So I can make real estate investing work. And when you look at China, rental yield is 1%. Mortgage financing rate is 6.5%. They don't have property tax yet, but still, that's pretty bad math, right? You're inverted from day one. So things gotta crash, right? That is until you realize no one in China buys real estate to rent. I learned that the hard way because I actually bought some real estate in China a long time ago, and I rented it out because I live in Boston. I don't live in China. When someone discovered that I rent out my real estate apartments, they ask, Jason, are you in financial trouble and need money? That was when I realized you don't rent out luxury apartment flats you own in China. That is a sign of like your business have failed and now you got to, rent out your homes to strangers. People in China buy real estate like my Indian friends buy gold. Like it is just a store value you own. It's not an income generating property. Most people, if you have neighbors, if you ever, this is especially true if you're, a Californian. You ever seen your neighbor come and outbid you for a house you want? They actually come with a duffel bag of cash, right? They buy apartments on cash. That's actually how they buy in China too, right? So there's not a leverage issue that'll cause things to blow up. It's just something we don't really think about and understand this way. So this prediction of a housing crisis is certainly just kind of, our failure to understand how real estate purchases are actually done in China. So that's one thing. So something else that is also kind of a misnomer and a bit of a surprise is, we tend to think of regulators. And when we think of regulators, we think of sort of, state-owned enterprises. Something that comes to mind is we think of the DMV, right? So state-owned enterprises must perform poorly because they all look like the DMV. In China, my experience of the regulators, now again, it's not all, but many of them are more like the tiger moms we write about in books, right? There's they're all incredibly educated. They generally went to the very best school, so they'd be, be comparable to, you got regulators who have both industry experience and graduated from Harvard and MIT, which is a very strange thing when you run into them in China that way. And the view they have about regulation is, you're a tiger mom. You don't know any better, so it's their job to protect you. So when I spoke with the GM at the Shenzhen Stock Exchange, so one of the largest stock exchanges, I asked him, so you're opening up your market, trying to attract foreign capital. So, why exactly, what are you trying to accomplish? And he says, we don't actually need foreign capital. We have way too much money in China. Or all these gambling money is actually quite unhealthy. My biggest problem is, on a bad day when the stock market falls a lot, I just don't want retail individuals to come out to the stock exchange and set stuff on fire and protest, right? That's what makes my life difficult. And so the result of which, they want to import global capital into China, not because they need the money, but they need a price discovery. They are trying to get rid of their retail individuals because otherwise prices are random. And it encourages sort of bad firms and bad operators, to go out and hype stocks. So that's part of what they want to accomplish, right? They're not wanting to attract foreign capital and trap you inside. That's not at all how they're thinking about their own markets. And there's actually a great sense of self-awareness. Something else that's interesting as well, our stock exchange in the US, they're for-profit entities. They're not part of the regulatory body. In China, the stock exchanges are part of the regulatory body. So if you approve a stock to go IPO, and it turns out to be, a Thorano or FTX, you go to jail for a very long time as the guy who approved the deal. So the regulator, the stock exchange in China, thinks of the firm and his underwriter as basically evil people in cahoots trying to defraud investors, right? Just like that's their standard understanding of the average firm and the investment banks. And so they actually have to do a lot of parallel revetting So one interesting thing you see in China is the stock exchange actually hires an army of sell-side researchers. What would compare to sell-side researchers? They work at the stock exchange, and they'll go interview companies independently because they don't trust what the sell-side banks are actually doing, and they'll publish those reports. And the stock exchange officials are so concerned about a stock that they cover or have ownership on going bust and getting in trouble, they'll regularly write these inquiry letters to the company and say, hey, your CEO said this. This is your tax filing. This is your filing with exchange. Things don't match up. Could you explain? Like one of the funniest examples was there was a scallop farming operation in China. It's actually a very large listed company that does sort of seafood. And one year they said their scallops swam away. You should watch a video. Scallops actually swim super fast. I actually didn't know that. So they could actually run away from you. But it just seems so ridiculous that the exchange got really pissed off. And so they commandeer satellites and just took satellite imaging, going as far as back that they have imaging, and proved to the company that no, you never planted enough scallop to make the kind of EPS claim that you're forecasting, and thus launching a major investigation. So these are just sort of things that are sort of different in China. And there are many things like that are just really different from the US, that using the American lens to understand how the regulator works, to understand how rules work, and to understand how the investors think about markets will generally lead you astray. All right, so let me just conclude with one final story before I get off the stage, because I see little signs in the back already. So for those of you who have seen the DD debacle, right? Like this is basic. DD is the Uber equivalent in China, right? It's the only game in town in China if you want to hail a ride. In fact, it's so dominant. I think they have an active user like 300 million, 400 million riders, so very profitable business. They were seeking listing in the U.S. And of course, the minute they got listed, the regulator from China slapped a massive fine on them. And all of a sudden, a lot of American investors saw their investment in that company decline by 50, 60%. And it was easy to say, God, the Chinese regulators really screwed with American investors, and this is likely to happen over and over again. How can you trust the Chinese? So I kind of tell you, so it's an interesting conspiracy, right? But I'll tell you the actual backstory, which is equally interesting. So this all got started with a Tesla crash in China. So there was a Tesla crash, and the Transportation Authority investigated the Tesla crash. And that was when they discovered, hey, a Tesla car records everything inside the car, around the car, and stream it back to the American server for analysis. Now it's all perfectly above board, because that's how Elon was sort of improving quality of the car, the autonomous driving. But of course, the Chinese quickly realized, holy cow. And immediately they announced, no Chinese public officials can ride in a Tesla anymore, for obvious reasons. You probably shouldn't be discussing state secrets inside a Tesla car. And then they go, where else is this happening? And they realize in their own DD cars, everything is recorded to protect the driver and the passenger, right? You just don't want them to mug each other. And then, of course, for China, data privacy is never an issue, right? The Communist Party feels like they own all the data, so they never decide to write a law about data privacy. Until DD says, oh, we're going to go and list in the US and become an American company. Right? They go, oh, wait, right? You were a Chinese company operating in China under the full jurisdiction of the party, so, it's fine. But once you go abroad, and if most people invest in you are American pension funds, do you become a firm owned by the American government? If so, does all that data then belong to the American government? They didn't really know how to think about it, so they emailed DD and said, don't seek listing yet. We kind of have to get this figured out first. And of course, this founding team and the VC capital behind the firm got freaked out and sought listing, right? They went from filing to raising the money to listing in 9 days, right? I don't think anything worked that fast on the New York Stock Exchange. And clearly that royally pissed off the regulators, and the regulator came pretty hard on them. Again, this final story is just meant to tell you a lot of what we actually hear here that's in our media about why or what has happened in China is one-sided story, oftentimes sensationalized to make the other side bad and wrong. Now again, sometimes it's warranted and correct. I would say oftentimes it's sort of biased and incomplete. Again, as an investor, the question you really want to ask yourself is not, hey, do I have some concerns with the Communist Party? You should. Should I have some concern with one guy being in power for too long? You should. But the other question really you want to ask is, does the price right now reflect way too much of the one-sided negativity in the press? Meaning, look, there's definitely risk, but are you more than well paid for taking some of that risk? All right, that's the bulk of my talk. Thank you for your time.